Okay, look, Sharif, we still have almost a month, maybe just under a month, till the next Federal Reserve meeting in May. And the weakness that we've seen in the dollar and the fact that the index dropped to a 12-month low is a reflection of all the data disappointments that we had last week, the retail sales number, the inflation data. But I think that even though we've had declines in consumer spending and inflation, if you look at what's happening in the markets right now, which more specifically, the fact that oil prices are at $82 a barrel, and we've basically had a parabolic rise or recovery in the U.S. equity market since the bottom in March, that all of that is indicating that the anxiety that the market had before that may have caused a lot of Americans, a lot of consumers to pull back their spending is starting to ease. And even though inflationary pressures did ease, according to the latest report, they've probably come back quite a bit over the past month as oil prices and commodity prices start to recover. I think everyone admits that there are many sticky areas of inflation. And the fact that one of the more volatile indices, which eased a lot of people's concerns previously with oil prices declining, is now moved completely in the opposite direction, I think it's going to leave another rate hike on the table for the Federal Reserve. So, I think there's a pretty broad consensus that the Fed's going to raise by another 25 basis points in May. But I think the market, as you said, is underpricing the possibility of an additional quarter point, and maybe more, in terms of tightening. Right now, the Fed Fund futures show that analysts and investors are looking for the Federal Reserve to start cutting interest rates in the third quarter, which I think is too aggressive because we've had, the initial weakness in data, but I think, that we're not going to see significant deterioration.
I hear you, and I accept totally that the war against inflation has not been won and the Fed have got some work to do. But isn't the credit stress, aren't the tighter financial conditions, the tighter access to credit, isn't that doing the job of the Fed? And isn't that basically the equivalent of going by 25 basis points? And doesn't that justify the Fed holding off on May the 3rd?
Well, it has done a lot of the work for the Federal Reserve because if not for tightening of credit, they probably need to increase interest rates by another 50, 75 basis points. So yes, I do believe that it's taken some of the pressure off of their backs, but I do not think that it's going to lead them to hold rates steady in May. And I think that the market is over aggressive in its expectations for the Federal Reserve to start lowering interest rates. And that is why, even though the U.S. dollar has fallen to a 12-month low, and there is quite some time between now to the next Fed meeting, I think when the next Fed meeting rolls around and we actually see some additional data improvements in the following months of reports, that will end up happening is that the market will start to reconsider that the Federal Reserve won't be lowering interest rates in the third quarter, maybe not even in the fourth quarter. So that underpricing is what we're talking about.